And
Hello, everyone.
hi, everyone. How are you doing today?
Good evening.
I'm gonna take my headset off.
Yeah, take your headset off. Let's get started. Feel free to put your video on if you'd like, even just to say hello and give us any feedback about what you're hoping to get out of this evening, what maybe questions you'd like for us to address, or just say hello and set the stage for this evening. Thank you so much for coming. I see lots of people are coming in now as we get past the hour here.
Elaine had lots of good, challenging questions for you to think about as we get ready for tonight. Like, what did you hope to learn? What could you stand to gain from the financial abundance that is available through real estate investing? A lot of people get tripped up on these calculators. It's one of those common questions we get of, can you send us your calculator? And that's something that we are very resistant to on a principal basis. And we're going to talk about that tonight. And we hope that by the end of the next hour, you have a good grasp on why that is so very important to us. So is there anything that anyone specifically had a question about, or anything anyone wants to share before we dive in tonight?
You see lots of familiar names, lots of faces. Thank you guys for your attendance. For those of you that don't know us, maybe this is your first time, or you don't know a whole lot about us, we're Nick and Elaine Stockerberg. We're the owners of Black Swan Real Estate and Single Family Investing at Scale. So we do a lot of real estate investing ourselves, our personal portfolios, over 20 million now. Nick's a real estate agent and represents lots of other investors in deals as well. We have a property management company that manages all of our own assets and the assets of all of our investors. Very vertically integrated. We talk about that in a lot of our presentations. And one of the things we love to do is speaking and teaching. There kind of came a point in our investing career where we really no longer needed to invest. We had reached financial freedom. We had reached most of the financial goals we had set for ourselves. And what propelled us to continue is the relationships that we've been able to form with all of our investors. But we know there's lots and lots of people out there who aren't our investors that we'd love to be in relationship with. And the way to do that is through these events, through speaking and teaching. So we try to put these on about once a month. We did them in the fall and then kind of fell off in the winter time, but really reinvigorated this, got some help in putting together the technology and all of the emails and everything that you guys receive. And so we're committed to showing up here and spending about an hour a month just pouring value out and trying to teach the skills that we've learned through a decade of real estate investing, so that you can have a faster path to success, so that you can be equipped with all of the tools and insights. We've done state of the market. We felt like that was a really important place to start of what in the world is going on out there in the real estate market. It's certainly the craziest market we've ever experienced in the decade plus we've been doing this. Have some really interesting topics coming up in terms of an assessment of, now that we're kind of getting a little glimpse of this post-pandemic world with vaccinations out and mask mandates are essentially gone and the economy is open. What is real estate going to look like? What has changed maybe temporarily? What has changed permanently? So that'll be one of the topics that we have coming up, and lots of other things. Tonight, we're going to talk about deal analysis. Nick mentioned it's a common question. I would say at least once a day, one of us gets a phone call, an email, a text asking for our calculator. We basically never give it out. We really think that every investor should create their own calculator. It is such a powerful tool. It is such an important part of your investing journey and of your education. So that's why very early on in this monthly series, we're going to show you how to make the calculator, because we have all these requests for it. And essentially, you're going to get our calculator through this process. We just want you to create it along the way. So a lot of our presentations are more of like a podcast format where you can maybe be, driving or with the kids or whatever and kind of listen in. I think you will get a lot this evening if you do that format. And certainly we understand there's evening time and that sort of thing. But for those of you that have signed up, you will receive the recording as well. But if you are able to play along, if you're able to get to a computer, to have a screen up where you can pull up something like Google Sheets or Microsoft Excel so that you're able to create this calculator in real time, that's how you're going to get the most value out of this evening. So you'll get a ton of value out of listening, you'll get a ton of value out of watching, but you'll get the highest level of value out of actually participating and creating a calculator that you're then able to use forever in your investing journey.
Awesome. Now, before we get started, a word of warning. Elaine, this calculator, this is like the most important thing in any deal, right? Is being able to plug numbers into a calculator, right?
Yeah. So, if you ask maybe 9 out of 10 of investors, they would probably say yes. Yep. And our philosophy is very different. We use our calculator as a sanity check or as a kind of sense-making device of, we really like this deal. We really like this neighborhood. We really like this house. We like the business plan that we can execute on this. How do the numbers look? The numbers are always the last thing we go to. By the time we get to the calculator, we have some preconceived notions about whether or not that deal is going to be a good one. And then we're using the calculator to verify that. Lots of times, especially with the drastic shift in inventory and pricing over the last, say, 3 months, and the interest rate changes that happened after April, our calculator was really valuable because deals that we loved that would have worked really well, even 6, 8, 12 weeks ago, they were pretty thin. So that calculator was that sanity check tool. But we have always used our calculator last in the process, not first. We fall in love with the deal, fall in love with the quality of that asset. Those of you that come to a lot of our presentations, you hear that over and over and over. For those of you that are new this evening, if you take away one thing from this evening, let it be that the story of a deal is so much more important than the numbers. And you're probably thinking, they're crazy. Like, that is the exact opposite of what every real estate investor says. The numbers are important. The numbers are a sanity check. You have to make money at this. You have to cash flow for security. You want to buy assets that are going to create equity, that are going to create real wealth. But the story of that asset is the most important thing.
Absolutely. And it's important to have a deep understanding of these calculators. You can go dust off someone else's calculator. We would, part of us is tempted to like sell our calculator to you, and there's lots of calculators out there you can buy. Bigger Pockets has a great calculator that I think is a high quality tool. But let's do a really quick example of why it's so critical to have a deep understanding of this. So I'm going to do a screen share here, and this is going to get deep pretty quickly. So buckle up, because we're gonna cover some ground. So I'm going to zoom in on my screen so everyone can see this really well.
Just so we can have a sanity check. I know most of you have have your cameras off, but can I get like a chat or someone with a thumbs up or something? Can you see the Google sheet that we're sharing here on the screen? Catherine has a thumbs up. Good. Avi, thank you. Appreciate it, guys. If you can have your cameras on, it's always helpful for us. When we first started doing this, we were much more strict. We shared that Nick and I are in masterminds that we pay a ton of money to be in, and you're not even allowed to join these calls unless your camera's on, which as a mom, I'll be honest, I totally hate it. I'm like, listen, I'm trying to like wrangle children, and that's the end of the day when I have my robe on. But even just a few faces really gives us a lot of energy. So if you can, we'd love it, even if it's just for a few minutes. And if you can't listen, I totally get it. We're all working hard and have a million different things going on. So good to see you all, though.
We're going to do a little calculator magic trick. We're going to make the cash on cash rate of return for a live deal that we just got under contract day before yesterday magically increase. And if you don't have a firm grasp on the fundamentals, it would be easy to fall prey to this kind of fallacy. So we've got this deal here, and I'm not going to dive into it right now, but we've got a set of characteristics of this property: a rental rate of $1,850 per month, taxes, all kinds of expenses, and then we have a certain down payment and a certain amount of debt service. What I'm going to do is I'm going to take this exact scenario here, and I'm going to copy it and paste it down here. You can see everything updated. And then I'm going to say, what if we changed our debt on this deal and we brought a little bit larger down payment? So we'd originally assumed that we're going to do a down payment of 25%. Well, what would happen if we did a 35% down payment? So I'm going to edit this guy right here, go to 35%, and then I'm going to pull up my handy dandy debt service calculator, and our purchase price on this particular property was $270. And we're going to say it's a 35% down payment. And these are the same debt terms I believe we penciled in before. So our monthly payment on that debt now is $788, and our loan pay down is $276. Our debt pay down is $276, and our debt service is $788. And let's see what that did to our calculations. Well, would you look at that? This went from a 3.75% cash on cash to a 4.91% cash on cash. That's such a better deal, right? That's so much better. Everyone thinks that cash on cash rate of return is king. We have to get that 10% cash on cash. But what happened here? Now, if we're looking at a cash on cash rate of return calculator, which we find is kind of the stat people are looking at the most, it's a very valuable stat, but it's like the only stat on their radar sometimes. They might say that, well, clearly this deal is a better deal than this deal, not realizing it's the same deal. And what's our trade-off here? So we're losing a significant portion of our total annualized rate of return by making that trade-off here. And you can see we're picking up 1.2% on our cash-on-cash rate of return, but we're losing almost 5% on our total annualized rate of return. That doesn't feel like a good trade to me. So if you are just dusting
off, we're trading a lot of our cash, which the bank loves, because now the bank has 10% more security. But as an investor, you should hate that. You should
Right.
want your cash to either do more deals in a perfect world or just to stay liquid, because the same reason the bank wants your money is the reason you want your money, which is for security. The more liquid you are, the safer you are.
Absolutely. If you don't truly understand the difference between a total annualized rate of return and a cash on cash rate of return, it's impossible for you to use a tool that can tell you these things. And it's very easy for you to fool yourself or to be fooled by someone else if you're looking at someone else's pro forma. Let's say you're underwriting a syndication opportunity and they give you a certain internal rate of return target. If you don't have the ability to run that deal through your own calculations, it's very easy to manipulate those numbers and to paint a picture that's not entirely accurate. For example, we have penciled into this particular calculation a certain amount of appreciation. So we have 3% in this particular scenario. Now, if you go back for all data, all time in all urban residential markets for single family homes, almost a century of data, the gold standard number is a 4.4% annualized appreciation number. So as long as you didn't buy a house, a farmhouse in a rural area or something like that, if you bought a house anytime in the last century, pretty much, you should expect to see like a 4.4% appreciation rate on average. It would be very easy for us to just pencil in a different appreciation rate. We have a very conservative number in here. We're probably way too conservative in almost all the numbers that we put together. Now, if we just wanted to pencil this in, and what I'm going to do here is I'm going to copy this scenario here and cover this one up, and then I'm going to change my appreciation rate from 3% to 4.4%, the national average.
No,
that wasn't
you
right.
need another zero there.
44% appreciation.
Lord, no.
Yeah, that would be nice. You can see that we go from a 20.44% annualized rate of return to a 25.88% annualized rate of return. Massive difference in our rate of return just by monkeying with what our guess at appreciation figure might be. And let's say you're investing in a syndication, they might have a reversion cap rate in their pro forma, and that says at some point 5 years in the future, we think that we can sell this thing for a way better price than we're paying for it today, for no reason at all, just because we think that the market's going to be hotter then. And unless you have your own calculator, and unless you have the ability to make your own calculator, to really dig into their numbers, it's easy to fool yourself or to be fooled by someone else. So you have to understand this. This is a fundamental. You have to get your repetitions in. You have to go run 1,000 different scenarios. Make your own calculator and run deal after deal after deal through it. How many scenarios rather do you think we run on a daily basis?
I would say we use this calculator probably at least 10 times per day, and you might be thinking, I have no time for that. I'm a practicing physician or a working professional, or I have kids, or I only intend to buy a few properties this year. I hope by the end of this presentation, you see how when you master this calculator and you have it in a very simple, easy to understand spreadsheet, you're able to do it over and over and over, and you're able to play with figures very quickly. So you've already seen how we just cut and paste this down. So we have a spreadsheet of basically every deal we've analyzed, probably for about the last maybe 4 years. We've been using this calculator, and it is just literally thousands of rows. And we're able to go back in time. Yep, that's it. That's it. We're able to go back in time. We're able to look at deals as they've changed. The part that's blacked out there is the address. So we have the date that we analyzed that deal, the address, all of the different scenarios. Maybe we projected a certain rent, but we were maybe uncertain of rent because rent in the spring is different than rent in the summer, or maybe that property was a little bit different than any of the other properties in our portfolio. We're playing around with appreciation. So we tend to do our pro formas with a 3% appreciation rate, which is hopelessly conservative. But we don't invest for appreciation. That's a kind of a nuanced thing that I'm going to talk about here in a few minutes. We know that the historical appreciation is 4.4% over long periods of time. We know that in our investing career, appreciation has been more like 7, 8, 9%, which radically changes the number. And we're able to just cut and paste and have a dozen scenarios for any given property in probably about 15 minutes. And that is what I hope you can get to Probably not tonight, but you can get to having the calculator. And then if you really exercise this for say a month, you should be able to get to that level. Most of the numbers are either easily obtainable or are very similar from property to property. So you're able to make some quick assumptions, get the numbers in, and then stress test a bunch of different scenarios. So I would say we use it we probably do somewhere around 10 different scenarios per property, and we try to analyze at least 1,000 properties per year. So maybe
Easily, yeah.
maybe 10,000 iterations of that.
Yep.
per
And
year.
but you saw how fast it was. 30 seconds to say, what if we did a bigger down payment? I guess that one took 60 seconds. 30 seconds to say, what if our appreciation rate was the national average and not this more conservative number that we had penciled in? How would that impact our returns? So before a couple more notes here before we create our calculator together. I hope during this time you are firing up Excel, firing up Google Sheets, starting to copy down some of the stuff that you're seeing here, because we're going to go kind of cell by cell and help you make your own calculator. We can analyze anything through this. So we have a $10 million deal that we're working on right now that we're under contract on. We ran that same deal through this calculator.
Mhm.
You can make this thing super complicated. I don't think that's valuable. We have a huge disappreciation for kind of Wall Street financial engineering. If you can't fit any deal into half a dozen buckets of income and expense and return, it's probably not a deal. There's a good chance something is hidden in there that you're hiding from yourself or someone's hiding from you. And we encourage you to break it down and make it crazy simple. So you can get fancier than this if you want to, and you can go spend a lot of money buying really fancy calculators. I have just to see what's out there that are tens of thousands of lines of code in Excel or programming language, but I don't think it really needs to ever get any more complicated than this.
And in fact, we have used this exact calculator to analyze every single family home we've ever purchased for ourselves or for others. And then when we analyze larger deals, we tend to take the financials that are given to us from that seller. And what we've learned from doing lots of those deals is there's zero standardization. So for example, someone might break out management costs. Someone else might break out management salary, management benefits, management phone allowance, management mileage allowance. And so there's no easy way to compare the two. So what we will do is we will create a pro forma that matches whatever format the seller gives us. So if, for example, they say that their rents are $52,000 per month, and that's in just a rent bucket, we'll create a Google sheet just like this that just has a rent bucket. But if a different seller has, say, a rent bucket and then a pet rent bucket and then like a parking rent bucket, we'll create a Google sheet and break it out. And so we'll match our pro forma to whatever format the seller gave us. We'll run all those numbers, try to look to see what numbers do we think are correct, what numbers are maybe too high. Maybe we have a business plan where we could shave expenses, or what numbers are too low. Maybe we have a business plan where we could raise revenue, all of those sorts of things. We'll do that. So we have lots of those different spreadsheets in our Google Drive. And then we'll go back and we'll do it in our calculator. And we trust our calculator so much more. It's so much cleaner. It's so much simpler. It really looks at the basic ins and outs. If you think of a deal as like a human body, what are the major organ systems? How are each of those functioning? So what is the income? That's really just rents. What are the expenses? That gets to some of the key indicators that we're going to talk about, like net operating income, cash on cash, cash flow, annualized rate of return. And despite all of these very sophisticated analyses we've done on large, like 7- and 8-figure deals, we go back to our calculator over and over and over for that sanity check, because it's so simple, it's so easy to understand, and it gives us a very quick analysis. And then it allows us to compare something like a single family home to, say, a quad, to a 100-unit apartment building, to a commercial building. Few other calculators are going to be able to have that level of comparison across such a wide array of real estate assets, but this calculator is so simple that it allows that.
All right, so let's dive in. So we're going to build a calculator here live. I hope we're up to the task here. I hope we don't crumble under the pressure. So the nice thing is you can put whatever you want in here, right? So I like putting in dates, the date that we did the analysis. I think that's just a valuable thing. I think the historical data is really valuable to see. We can go back to calculations we made 5 years ago when it was like 10% cash on cash everywhere. And
then we weep and we say, I wish we had bought them all.
That's right. Yep. And a few years from now, we'll be like, oh, look at all those cash flow positive deals. That was so great. You know, I'm going to do this one vertically just to mix it up a little bit in case you like a vertical look better. You could say like market, for example. So maybe you'd say our market is Rochester and our today's date is 2021/5/26. What's another valuable piece of data that we could put into our calculator here? Let's try to just make something up for funsies, and please pipe it into chat. What's a valuable thing that you'd like to see in this calculator? Oh, that sounds like a challenge. Yeah, what's a metric you'd like to see? Let's see if we can calculate it live.
I'd like to see the address.
Address, that's
really
a good one.
That's really important to me because even within a market, I want to know what neighborhood is that property in.
So we're going to do a live deal here. So we're going to say 123 Main Street, but this is a deal that we just got under contract and used this calculator to analyze the purchase of 48 hours ago. Purchase price, closing costs, closing costs. That's one we don't have in our usual calculator, so I like having that one in there. Any other suggestions for things? Financing rate, okay. Let's say interest rate. We're going to say it's a 3.5% interest rate, and we're going to say that the closing costs equal purchase price times point. In our market, probably about 2% on a typical investment property. Somewhere in there would be our closing costs. So in this case, our purchase price was $270. And down payment. All right. And I'm going to say that we're going to do a 25% down payment. So I'm going to go equals purchase price times 0.25. And you could even, if you want to get real fancy, you could break this out into a separate thing and say like down payment percentage. And we could say 0.25. And then the down payment amount equals the purchase price times this. And if you want to, you could do loan size and do the inverse of that number or something like that. These are all great things to have in here. One number that I'm always very intrigued by is the rent amount. How much are we going to actually rent this thing for? So we'll say rent. And you know, if you're working like a commercial building or something, it'd be you know, gross potential income, something of that nature. So this particular property, what do we think the rental rate was?
1850 or 1900. I
think we actually did it way lower in the pro forma.
1850.
Yeah. Now, we actually listed on our website for 1950 today, but we like to just be conservative in our pro forma. So let's put in 1850. Expenses. Okay.
I'll interrupt there for a second while Nick's looking at the chat and kind of getting things going here. These are all great things. Thank you for the participation. That's really helpful. So Nick said, you know, we listed this property on our website today at 1950. That's the beauty of having a calculator that takes like 30 seconds to change your scenarios. So we can have kind of a best case scenario, a worst case scenario, and then a most likely scenario. And I would say for our particular underwriting, we tend to make our pro formas somewhere between like a worst case and a likely. We talk a lot about how perhaps we're too conservative, perhaps we're missing out on opportunities because we tend to be conservative. But you can decide if you're someone that wants to go a little more aggressive and wants to underwrite, like what is the absolute highest rent that I could possibly get, and can I get pet rent, and are there any other ways that I can add revenue? Then you can just do that over and over and over and have all the different comparisons there. All right, so for our expenses, we have taxes, utilities, insurance, vacancy, management, marketing.
We're missing a couple big ones.
Leasing cost.
I need a few more comments here, or we're gonna end up running our pro forma lean, and that's not gonna have good outcomes. Oh, you know what's a good one is expense ratio. I'm gonna put that up here. Expense ratio. That's a really interesting characteristic to monitor for multifamily. Single family expense ratio isn't quite as much of a thing. Leasing cost. I think we'll roll that one into the management rate, but that's a good one. I like a breakout for. There's two really big ones here. Expense for stress therapy. All right. CapEx. That is one of the two big ones that I was looking for.
Yeah, very good.
Yep. And then there's one more real big heavy hitter that we're probably missing on the expense side. And I know it, you know, in my gut because I've run this so many times.
Why don't we hear it from you?
Maintenance, repairs. Yeah. So we'll go ahead and put that in there.
Maintenance and turnover are your two most important
That's right.
costs as
That's right.
as a property owner.
And the two are linked. The more turnovers you have, the more maintenance you have. Probably 90% of our maintenance cost is incurred at turnover. So if you can keep your tenants happy and make them want to stay forever, you can radically reduce not just your vacancy cost, not just your management cost, but also your maintenance cost. It's very easy to keep an existing customer. It's hard to go out and get a new customer in any business.
One of the things I want to talk about from like a strategic level in terms of making the calculator is how many of these buckets do you want to break out versus how many do you want to keep together so that you can use the calculator very quickly. So like, for example, someone mentioned a leasing cost and someone else mentioned management. We lump both leasing costs and management together and we use a formula. And also, Nick gave the example of, well, you could calculate your down payment right into here, or you could put your down payment here and then use a formula to calculate it here. It's just a balance of what fills you with joy, what makes you look at the calculator and think, I understand this, I'm able to see everything I need to see. It's not so visually cluttered that I feel overwhelmed. Overwhelm is the most dangerous thing to a real estate investor. The moment you feel overwhelmed, your ability to analyze a deal falls precipitously. Your ability to execute your long range vision as a real estate investor falls off the cliff. So kind of finding that balance of using formulas, batching things together versus saying, I do want to separate this out. The difference between say maintenance and capital expenditures is very important to me. So I'm going to separate that out versus, it all sort of goes through my handyman. So I'm just going to put that in one bucket because I kind of think of that as, well, Joe, the handyman helps me with that. So each person will have a different vibe there. And going back to the beginning, that's why we don't give away our calculator, because each person should have what makes them feel excited to analyze a deal, what's the right level of information for them, the right level of formulas. One person might want a ton of formulas because they feel very confident in the formulas. They want to be able to just plug in a couple of numbers and kind of let the rest populate down. Another person might feel a little skittish around formulas and want to manually put in the information every time. There's no right or wrong. I would say our calculator is probably somewhere like right half in the middle.
Yeah.
So just one of the things I wanted to chime in there to kind of speak to like leasing costs and management as an example there.
All right, so here's what I did. We've got our income bucket here.
Quick check-in from the chat, from the people's faces. Any questions so far? Any thoughts? Should we just keep going?
Hopefully everyone's keeping pace and they're making their own calculator right along with us in real time. I'm going to take that silence as everyone is busy running creative scenarios on their real estate deals they're working on with their brand new calculator here.
Love it.
So for income, I just said that's equal to rent on, let's say a multifamily property. You might have vending income, coin op laundry, parking rental, that sort of thing as additional income sources beyond rent. For the single family home, just rent is our income. For expenses, all I did was just do a sum of all these cells here, all these other expenses that we came up with. So let's do taxes. Normally we'd go to our assessor's website and just look up the taxes.
Let's show that.
Sure.
Yeah.
So
while Nick's pulling that up and sharing that screen, almost every county in the country has like freedom of information laws that say that property ownership and tax rate is publicly available information. So you can generally go in and pull up any property address, just like Nick's doing, and find information about the property taxes. There's all sorts of other information that's available that's outside of the scope of tonight. And it's different for every county based on what like website they use and what information servicer they use, but you can almost always find the property tax. Whatever market you're investing in, you should know this website like very quickly. You should be able to pull it up, get directly to the page you need, pull the number you off, and then pull off the number you need and then close it.
So I just pulled up a random property that we own here, Black Swan Real Estate Series 16 LLC. And this is just have average taxes for our area of $20.44 per year. Make sure you check to see whether or not that is a homestead exemption. So if we go over to property tax information, we can see whether or not it's a homestead. Again, your website in your area is going to be different, but it's going to have all the same information. So this one's already non-homestead. If it was a homestead, we'd have to bump up our tax rate in our area. It's about a 10% increase for non-homestead single-family residential property. So we just bump that up by 10%. There's even a calculator on the county's website that lets us exactly estimate that depending on which tax district you're in, what school district you're in, the exact address of the property, their special tax assessments or anything on that particular address. And then another thing to consider is property values. So if we look at our property tax information here, we've got 2484 is our total tax for 2020. If we go over to 2021, we don't have anything in here yet. Now, if we look at values, we can see that our value went up from 180 to 191. So it went up by about 5%. Now we want to be projecting our year one outcomes. So we probably need to bump up our estimated tax value by about 5% for the taxes that we're going to pay next year. So I literally whip out a calculator here and do 2484 times 1.05. That gives us 2608 per year divided by 12. That gives us $217 per month. It is no more complicated than this.
Once you've done this a couple hundred times for your target market, you'll be able to very quickly know that property is worth about this much money and that's the tax amount. And let's say you're out and about on your phone, or you're looking at a deal, or your real estate agent calls you or something, you can kind of quickly put in a number. So we generally, when we're kind of out and about making quick decisions, we put in about 225 for kind of a modest home and 250 for what we would consider to be like a nicer home. We're able to have that luxury because we've done this a couple thousand times. You will too. When you've done it a couple hundred or 1,000 times, you'll be able to quickly know and then always go back and verify the tax amount. Maybe that's in a neighborhood where there's additional tax because a road was built or a new school is coming in or there's a special assessment or that sort of thing. But again, just speaking to the value of doing this many, many times, the first, maybe 20 times you do this, it might take you 15 minutes per time. And then you're going to get some speed to where you can run these scenarios and do 20 scenarios in 15 minutes.
So someone called out debt service as one of our considerations there, as well as our amortization period. And I'm going to put a little bucket here called debt for that. Keep calling out things that you would like to see on the calculator here. So utilities. In our area, the property owner needs to pay for stormwater. So that's a $9 per month expense for a single family home. We can just leave it at that. If we had like a multifamily property, we'd probably need to pencil in some master metered utilities. So water, probably natural gas, hopefully not electricity. And if it's property that you're acquiring, typically in your area, you're going to be able to contact the utility companies or something like that, and they're required to give you a de-identified average monthly bill for the trailing 12. That's just a freedom of information kind of thing that is available in most areas. And you can make some pretty good educated guesses. So for this property, it's really simple, $9 a month for stormwater, no other utilities that we're responsible for. Insurance.
Utilities is one of the most important things to analyze in small multifamily. Let's say a purpose-built quad where all of the utilities are separate and the tenants are paying them, that transacts at, say, I don't know, 400,000 versus a non-purpose-built quad, or maybe it was purpose-built, but just the way it was set up, some of the utilities are the responsibility of the owner that transacts at 400,000. Those are radically different investments. You might say, well, I'm just going to bill back on that second example. I'm just going to bill back the utilities. Just the fact that the utilities are broken out makes the first one more valuable because it eases the underwriting.
Nancy called out rehab. That's an excellent item to have in our calculator here. Insurance. So for our area with a high deductible plan with the maximum coverages for liability, which is what we're really concerned about as landlords, not a hail claim, but does the property burn to the ground or do we get sued? For us, that costs about $65 per month. So that's what we'll pencil in.
I like to put in 75.
Okay.
Nick and I disagree on that.
Let's be conservative.
I think it tends to come around 72 or so.
So the turnover vacancy in our portfolio historically all time is around 1%, but that's ridiculously low. What do you think would be a good vacancy number to pencil in? Let's ask the brain trust here. 5%. I would say that's about as close as there is to a gold standard is 5%.
Any other numbers? Okay, we've got another 5% there. I like to think about it as there's 52 weeks in the year. So basically each week is about 2%. If I have a tenant that's moving out every year, how quickly can I get that property cleaned up, any turnover, and then get someone in? And so if I think, maybe 2 weeks, maybe it takes a month, but a tenant stays on average 2 years. So that's, about 2 weeks every calendar year. That's kind of how we get to 5% there.
Yep, and you need to make sure that you're looking at economic vacancy, not physical vacancy. So we do have physical vacancy well in excess of 1%, but our economic vacancy is 1% or less. Now, usually it's the other way around. You have people in your properties that aren't paying. We frequently have people that are not in our properties, but are paying because we're able to negotiate, win-win deals where they may vacate a little bit early, and we're able to help them with that transition. And in exchange, they might pay rent through the rest of the month while we're doing our turnover and make ready for the next tenant to move in.
We got a question. What formula did you use for vacancy?
So
let's go through that a little bit slower.
Yeah. So this is a slightly confusing calculation. Basically, vacancy is accounted for in most real estate underwriting as an expense. Now, logically, it seems like what you do is you take your rent amount and you just reduce that, right? But if you're doing a pro forma analysis, it's really valuable to say, what do we think the market rent is? So $18.50 per month. And then what if we have double the usual vacancy because there's an economic downturn or something like that? So we're going to keep our rental rate the same, but we're going to modulate our vacancy. It's also very easy to break out to get a little bit fancier. So for example, you can add a bucket called loss to lease. We're not going to include that in this calculator. That's too fancy in my opinion. But basically we're saying if we were to lease that property today, what's the market rate on that particular property? And if you are in a climate where there's a lot of rent growth, it's like 10% annual rent growth, it seems like in our market these days. You're in a situation where no matter how long ago you leased that unit, even if it was like last month, there's already a little bit of loss to lease because there's been a little bit of rent growth since that tenant was placed. So it's very handy to keep your income, your rent number static and not manipulate it, and then to manipulate things like vacancy and loss to lease in the expense buckets. Excellent question.
So you can see there, Nick just took the rental amount times 5% to give us about $93 per month that we can kind of think that we're kind of setting aside in a bucket in our minds to cover vacancy.
Yep. Management, this is a tough one. So in most markets, it's kind of a race to the bottom on management rate, and you are able to get a management company to quote you extraordinarily low management rates if you cold call them. Just like an airline will quote you a very low airfare fee. I know, Elaine, you just booked me a flight
of
a economy puny class.
Basic economy.
It was a basic value economy. They had some words in there.
It was like, well, you can get on the plane, but don't bring your bags, and you're going to be sitting in the aisle.
That's right. Yeah, they made it clear we're going to make you real uncomfortable. The point being that it's a race to the bottom on rate, and then the typical property management company makes about 30 to 50% of their total revenue in ancillary fees, and almost all of their profit comes from those ancillary fees. So if they're quoting you, let's say, an 8% management rate, which I would say is the closest thing there is to a national average on such a rate, you should probably pencil in a 12% management rate for your all-in management costs. There's typically going to be fees for inspection, onboarding fees, contract termination fees, tenant placement fees, renewal fees. There's a litany of back end things that you need to take into consideration. One of the biggest ones is going to be pet rent, for example. So most property management companies, they have an administrative fee when a tenant moves in. The management company keeps that, doesn't go to the owner. They also have a pet administrative fee that goes to the management company, doesn't go to the owner. They also have a non-refundable pet deposit that frequently goes to the property management company, not to the owner. That one sometimes does go to the owner. Then they have a pet rent amount, and that usually goes to the owner, but not always. And then there's typically a management fee split on that amount as well. So you have to think about what your all-in management cost is. And almost every pro forma that I ever see, they are underselling themselves on what their all-in management cost is. So that's something people sell themselves short on management and capex. Those are the two buckets where I see people make big mistakes. So we're going to pencil in a 12% all-in management cost here. So our rent is $18.50 times 0.12, $222 per month. You can see it is our number one expense so far, and that's the reality of the situation. You need to make sure that you're being transparent with yourself about that. Marketing. So we don't usually have this bucket on there, but that is something to think about. Most management companies pass through the marketing cost on the unit to the property owner. We don't do that, and we don't tend to spend a lot on marketing.
Yeah, for whoever chimed in with marketing, what were you thinking there? You mind sharing? either unmute yourself and talk, or throw something in the chat. Looks like it was Jenny, advertising. So say more. Are you thinking someone who's self-managing, someone who's okay, online? Okay. So for someone who's self-managing, in most markets, Zillow now charges $10 per week for a listing. That's not in every market in the country, but it's getting pretty close at this point.
Craigslist will charge. A lot of places now charge like
a little bit.
A little bit.
Yeah. Riley's our leasing manager. I know I saw him here a little bit ago. Riley, shake your head, yes or no. Is Zumper charging? I'm nodding my head as though that's going to change. Oh, it looks like he's on the phone.
Working hard.
I think
hopefully
probably leasing one of our units.
Riley
man there, he works hard for us. And for many of our investors on this call. So let's say someone's self-managing. I would imagine that their marketing costs might be like $20 per year.
Yeah.
That would not rise to the level of that I would want that on the pro forma. To me, that's going to be noise, that's going to be static, that's going to make stress, that's going to lead to overwhelm in my world. I know a little bit about your investment strategy, Jenny, and I think you do more larger assets. Larger assets do tend to have marketing because places like apartments.com will they have a free section, or they have like the $10 per week section, but because let's say large multifamily is more of like a commodity type of housing as compared to single family, it can be very expensive to get an apartment building promoted on apartments.com. Right. So that it shows up on the search, anywhere in a place that you can't be last, because someone is looking to move to a community. They need a 3-bedroom apartment. Maybe they want pets allowed and a pool and within 5 miles of their workplace. Well, they're not going to scroll through 50 apartment buildings. They're going to scroll through maybe 5, and it costs quite a bit of money to get into, say, those top 5. What's the quote that we got for our townhome community?
The most basic marketing package that we can possibly pay is $500 a month, and it is really quick to get to $5,000 per month for only 30 units. So it adds up very quickly. You can pay to get promoted on Google. Trying to advertise a multifamily property.
Multifamily is very different. Yeah. And so when we're working on like some of the deals we're looking at are like 100 unit apartment complexes, we will have some of those units listed on Zillow at $10 per month, but then we will likely also pay quite a bit of money to have those promoted on like apartments.com and that sort of thing. So we would include a marketing expense for that. Now we would do that because we are the managers of that asset. I would say that someone who is hiring a property management company, I would think it's typically standard that the property management company is paying those marketing expenses. Unless it's a large multifamily, then they're going to pass that through. For single family homes, I don't find that including marketing is needed on the pro forma.
So we're going to pick up the pace a little bit because I don't think we're going to get through our calculation here the way we're going right now. So there was a quick question there for single family property management, bear the cost and service of getting tenants. In general, yes. Yeah, I mean, it varies, but in general, yes.
And it's different across the country. Some places have a flat rate. Some places have a leasing commission plus a flat rate, all sorts of variations. That's why Nick mentioned kind of a national average might be 12% to get the all-in cost. And different management companies are going to slice and dice that differently in terms of their leasing commission, their rental amount, maybe maintenance, inspections, those sorts of things.
Yep. So in our maintenance bucket on a single family home, I'm going to pencil in about $30 per month, somewhere in that territory. And that's just our number. That may not be an accurate number. And I'm going to pencil in about $70 per month for capital expenditure, which is something that always really ambushes people. It surprises them. It's shocking how expensive capital expenditure is. But let's do a very brief exercise here. So let's say that we have a single family home that has a roof on it. And that roof costs about $7,000 to replace for a typical home in our market. This is going to vary by market a little bit. And that roof has a service life of approximately 30 years, assuming it doesn't get impacted by wind or hailstorm or something along those lines. So we divide that by 30 years and we divide that by 12 months in the year. We pay $20 per month to have a roof over our heads. And that's just one system in the entire house. So let's say you have a water heater that costs $1,000 and that water heater has a service life of approximately 7 years. And then we divide that by 12 months, cost us $11 per month. So we're already up to $30 just between the water heater and the roof. So this adds up extraordinarily quickly. This is a quiet cost. It's not uncommon for people to get into investment property that looks like it's cash flow positive, and then 5 years in, they have to replace the roof. And that one roof replacement wipes out all the cash flow they've made for that property the entire time. So you have to be very transparent with yourself about your real maintenance and capital expenditure costs. We try really hard to acquire properties that have what we call prepaid
You're not
capital.
don't Google that because you won't find
Yeah.
it, but prepaid capital expenditures. So in our market, that's things like vinyl siding, vinyl windows, newer roof, newer water heaters, newer furnaces, HVAC systems. For the kind of the average buyer in single family homes, they're buying based on design, wet rooms, so kitchens and bathrooms, and neighborhood. They're not running into the basement to see how old the furnace is. We run to the basement and see how old is the furnace and is there any evidence of water intrusion.
We can,
So we try to find properties that we kind of think of as you're kind of getting it like for free. It doesn't hold value in the market the same way like a beautiful kitchen would. Say a house that has wood siding versus a house that has vinyl siding. We're going to take a vinyl siding house every time.
absolutely. So altogether, we now have expenses of $720 per month against income of $1,850 per month. We're missing a really critical number here. Does anyone see what number is missing in our calculator right now?
Yeah,
So we do have the debt service right here on line 11. Thank you, Ron. This is the next step in our calculation. So we have income of $1,850 per month and expenses of $720 per month. Property management, we got that already. Thank you, Riley.
what is income minus expenses? 3 letters, 3 words.
Net
Yeah,
NOI.
NOI.
That's exactly right.
Extremely important metric. Extremely important. That is your, it holds steady when financing changes. So person A might decide to have an unleveraged real estate property. Person B might have purchased the property in, say, 2008 when interest rates were 5.5%. Person C might have purchased the property 3 months ago when interest rates were under 3%. Those 3 people are going to have radically different outcomes in terms of their cash flow, but the property is still the property, right? Does that intuitively make sense that the cash flow is going to be different for those 3 individuals, but their income and their expenses are still the same. It's the same property. And the way you compare that apples to apples is NOI. And only after calculating NOI do we even talk about what the debt terms are.
And there's another number that's very closely correlated to NOI. So if you have NOI and purchase price, what's the other really big metric that you can calculate that you hear a lot about?
You don't hear a lot about it from us.
Yeah.
But people talk about it.
So if you have your purchase price and you have your NOI cap rate, that's exactly right. So what's a good cap rate these days? So we're going to divide our NOI by our purchase price. And that gives us a cap rate of 4.1%. Oh, that's a terrible cap rate. We shouldn't have bought it. It's a terrible deal. It's 7 cap only. That's all we buy. Okay, so now that we have our NOI, and we have our, we haven't calculated our debt service yet. So if you want to, you could put an amortization calculator into your spreadsheet. We deliberately keep it simple. We have our amortization calculator separate from that. So we have a purchase price of $270,000. We have an
Go ahead.
Down payment of 25%. We've got a loan term of 30 years and an interest rate of 3.5%. That gives us $909 per month of debt service. So we're going to pencil in debt service of $909. And we're going to put in an amortization of 30 years there. And then right next to debt service, we always like to pencil in our debt pay down amount. So we'd have $318 per month of debt pay down.
Because that's really different than debt service. Debt service is your pay down plus your interest. Interest is just the cost of doing business with the bank. debt pay down is like a savings account that you're creating with yourself. One of the things I wanted to chime in there is that Nick and I have created our own amortization calculator, mostly because we need to have it on our phones at all times. That's probably not true for most people listening. There are fabulous amortization calculators out there, like Bankrate has one, a couple others. Just Google amortization calculator. The first like 5 results are great. I do use those sometimes when I'm on the fly or if ours gets a little bug in it. But basically, you just need to know purchase price, interest rate, and the term, and then down payment. And those variables are going to give you your overall mortgage payment, and then what percentage of that mortgage payment each month goes to debt pay down. In some of those calculators, they're going to like auto populate in like an estimation for property taxes, an estimation for insurance, and maybe an estimation for PMI. So if you use one that's available on the internet, just make sure you put those numbers at 0. You're not going to have PMI as an investor because you're putting at least 20% down, and you've already calculated with real numbers your insurance and your taxes. So you don't want to like double count that accidentally in that amortization calculator that you might find on the internet.
Okay, so we now have our debt service and our NOI. What does that allow us to calculate? That number one freedom metric that everyone loves so much. Some might argue it's the most important metric. I might join them. I don't know, maybe not.
Cash flow.
Cash flow. So we're going to down here, put it right above NOI. Cash flow. And we're just going to take our NOI and we're going to subtract out our debt service. And that gives us cash flow of $220 per month. So you've
Pretty
heard
solid.
rules of thumb, like if you can get $100 or $200 per door per month or something, you've probably got a decent cash flowing deal. I would say this meets that gut check there.
One of the things that becomes extremely intuitive when you're doing this calculation over and over and over is how important your rental amount is. So if you have a ho-hum manager that delivers ho-hum customer service, and maybe the standard on this property is $1,850, but they're kind of ho-hum and they kind of putz around, and maybe they can only get $1,800 because it takes them a little bit longer and it gets a little stale on market.
Over here.
Then it, they have to reduce the price, that sort of thing. There we go. So you can see it takes the cash flow from $216 per month to $175.
Yep.
Right. It intuitively makes sense that after your expenses are paid, that's when you as the investor, that's the first dollar that you profit, is after all of your expenses and debt service are paid. So every dollar that you can eke out after that, either through self-management or through competent property management, is pure profit, and it radically changes the numbers. Maybe you have a rock star property manager that's able to do phenomenal photography, has amazing customer service, returns calls very quickly. They're able to get a little above market consistently, and they're able to get $1,900. Well, now you can see the cash flow goes from $216 to $282. Let's take the top one here. We'll do the ho-hum property manager versus the rockstar property manager. We go from $175 per month to $260. It takes our cash on cash from 3% to almost 4.5%. Someone might quickly look at a deal and say, like, well, what's $100 in rent? Or I can't estimate rent that closely. I don't know the market that well. I'm not, living and breathing as a property manager every day. So either self-managing with extreme attention to detail and customer service, or finding the best property manager you possibly can, because every dollar after expenses are paid that can be eked out of that property is pure profit for you.
All right, so let's do some quick calculations here. We're going to we've got our all-in cost here, which I add up our closing cost, purchase price, everything. And then I'm also going to do our cash to close. And for that, I'm going to add up the closing costs plus the, that's not going to get us anything. I'm going to do the closing costs plus the rehab costs plus the down payment. So we have to write a check for $75,000 to buy this property. And that's going to get us to two of our most critical metrics here. And they're both going to be expressed in percentages. One person already got it there, our cash on cash rate of return. So cash on cash rate of return. And that's a super simple calculation. We're just going to take our cash flow. So that's the calculation we did right here, $220 per month. And we need to multiply that by 12, because this is an annualized figure. and then we're going to divide that by the amount of cash flow that, or total cash to close. That's going to give us a 3.53% cash on cash rate of return. I hope everyone followed how we calculated that. So literally just what's the cash you need to have the deal, and what's the cash per year that's spitting out. That's as simple as it gets. And then there's one other really critical metric that we like to calculate here. That's probably the one we care about the most.
This is our
Yeah.
most important metric.
That's
There's too much. The scope of this presentation doesn't include this. Maybe we'll do a separate monthly call on this of what are the KPIs or the key performance indicators that you're looking for in a property. What's important to you? It's going to be very different. Say someone who's maybe fresh out of college, house hacking a duplex versus someone who's maybe in their 60s or 70s and is looking to protect wealth. They're going to have very different desires for their portfolios. We used to focus very heavily on cash flow until we reached financial freedom. And then now we focus more on annualized rate of return because we can buy deals that have a little bit thinner cash flow if they're going to produce a large return over our hold period. And then also the market has shifted. So 5-6 years ago, it was pretty easy to get like an 8 or 10% cash on cash rate of return. Today, we're looking at 2.5 to 4.5, maybe 5. And so there just aren't as many cash flowing deals out there, but we still want to buy deals that are going to yield a high annualized rate of return. And we do that by buying properties that we project will enjoy forced appreciation and market appreciation through buying strategically, doing strategic rehabs, buying in areas that are improving because maybe a new school is being built or a new park or that sort of thing. We're in our market because there's extraordinarily high population and job growth. Anytime there's more people that need more housing, the cost of and the value of housing is going to go up. So that's kind of what we're getting at here of what are all of the returns that we're getting, not just cash flow, but the other buckets of returns that Nick's going to talk about, and what's the highest number we can get in that bucket.
So to do this, we're going to add up our debt paid out. So the amount of principal that's being retired each month that we successfully make that mortgage payment. And then I did a little calculation here on the monthly appreciation. So I just took 4.4% times the purchase price divided by 12. So we're going to add the debt pay down. Oh, Google didn't like whatever I did there. Plus the monthly appreciation, plus the cash flow. And that's going to give us 1528. 1528 in cash flow plus appreciation plus debt pay down. And then I'm going to divide that number by our total cash to close.
Multiply by 12.
By 12. Yeah. There we go. So we have a 24.5% total annualized rate of return. And these numbers are similar to the numbers in our calculator we started with. So we're pretty sure we did this right. Or at least we made complementary errors as we were putting this calculator together. And I hope you can see that, like, we literally just threw this together, on the spot, putting in some different metrics we don't usually use, calculating things, the same way we've done them before, but in a different format. And we think it is beyond critical that you develop the confidence to be able to kind of go through this exercise on your own, to create your own calculator, to have the ability to come up with your own calculation, your own rules, your own KPIs, your own metrics on what makes a deal for you. There's one question we didn't get a chance to answer that we got earlier that I think is a really fantastic question, which is, yes, there's the link to the sheet we've been working on here, your cheat sheet. So the question was,
while Nick's looking that up, I was feeling very generous. So I shared our Google Doc there to thank you for coming, for spending an hour out of your very precious time with us. And hopefully you've learned a great deal. But also that there are a lot of formulas that we talked through quickly. And I sincerely hope that you were at minimum watching intently as we created this calculator, but hopefully creating your own. If you need the formulas or you kind of want to take this and tweak it to how you want, I wanted to make that available. So that is there. You'll be able to open that up, cut and paste out. I see a bunch of you hopping in. I love it. Cut and paste out, click on things, see the formulas. I thought that was something that we were kind of going a little bit quickly, and some of the formulas are annualized, some of them aren't, particularly that annualized rate of return formula. That's the most important. And you can kind of think of it, what I have learned from doing this thousands of times is if we look here, at annualized rate of return, we have B17, B18, and B23. So I'm just going to cut and paste that just here for a second. So that's about $1,500. Our rent is a $1,850. So if we just do that math, I'm just dividing our total money buckets divided by income. We want that expressed as a percentage. It's about 82%. So I think in my mind of about a 75%. So someone can quickly think of their rental portfolio and think, I collect about $10,000 per month in rents across my portfolio. For single family homes. For multifamily, it's going to be very different based on if you're paying utilities and those sorts of things. But in our market with the tax and the utilities are paid by tenants and that sort of thing, I can kind of quickly think the rental amount that's collected, the owner of those properties and their overall wealth bucket is getting about 75% of that. And that's like a really quick, like if you're collecting 10,000 per month in rents, you're collecting for your own personal balance sheet about 7,500 per month in cash flow, debt pay down, and appreciation.
So Mark had a question. Do you ever have any type of tax consequence in your pro forma? So we got about a third of the material covered tonight that we have planned here. So we'll have to do
which is usual.
Yeah, which is usual.
Those of you that know us are like, yep.
And then there was a question there of a refinance test or a payback period to put into your calculator. So the question wasn't payback period, it was refinance test. So I think payback period is one of the best metrics you can possibly have. I think it's one of the most understandable metrics, which is basically how long does it take to get my money back? So if we add up our annual cash flow appreciation debt pay down on this particular property, we're gonna make about $18,000 per year in cash flow appreciation debt pay down. And so to figure out how quickly we can get our money back, that would be this number divided by your total cash to close. So this is I'm not sure about the formatting on this here.
You want it to be like a clear formatting?
I'm sorry, I did the math backwards. I need to divide.
Yes, yep.
So the payback period is the inverse of your total annualized. No, that's not right either. Oh, I think it's doing this order of operations out of sequence. There we go. So your payback period is your inverse of your total annualized rate of return. So if you get your money back in about 4 years, you're in really good shape. I think if you can get your money back within 5 years, that's just a really good benchmark for any investment. If you're buying a stock or gold or syndication or something like that, you can get your money back in X number of years. Like that's not a percent. It's so easy to understand. A completely lay person who's never heard of a cash and cash rate of return. Okay, so let me get this straight. I buy this house, and 5 years from now, I get all my money back, and I still have the house.
Sounds good.
That sounds like a great deal to me.
That's basically what we've done over and over and over. We joke that we're Black Swan real estate. We really should just be Golden Goose real estate. How many Golden Goose can we create? And how quickly can we create them? It used to be when the market was a little bit different that we were creating that through forced appreciation, through doing renovations and then refinancing out. It's a little bit harder to do right now, but market appreciation is much higher than it used to be. So we're seeing people that bought properties like even 18 months or 2 years ago that are already able to do a cash out refi. So the underlying strategy has changed, but the overarching strategy is exactly the same. How quickly can I buy a cash flowing asset so that I have security? How quickly can I get all of my money back so I have an infinite rate of return? And then this calculator all of a sudden isn't very important anymore. Once you have an infinite rate of return, you're going to be in a very good position. And then I can deploy that capital to something else and continue to cash flow from that asset in perpetuity.
Absolutely. Oh, here's how I can merge that question with Mark's question. And hopefully this doesn't get too deep. So we love the cash out refi, and there's huge advantages to it. So let's say you had a property where you had enough equity that you could do a cash out refi and you chose not to. You'd have more cash flow over the next, say 5 years or whatever, because your debt service on that property is lower. However, you would end up paying ordinary income tax, most likely on that rental income. I can't comment on your tax situation, but the tax basis for that income is depending on how everything's structured. There's a good chance that's ordinary income. Whereas if you do a cash out refi, those loan proceeds, because they're backed by qualified debt on your tax return, are completely tax free. And then the interest you pay on the loan is tax deductible. And that allows you to go take that money to go out and buy another property, which allows you to get even more depreciation. You do cost segregation and bonus depreciation, all that sort of thing on the new property. So if you have the ability to do a cash out refi, it almost always makes sense to do so. It's a rare circumstance where it doesn't make sense to do a cash out refi if you have the ability to do so. So hopefully I could merge those two concepts there of some calculation on tax advantage along with a refinance calculation.
Yeah. So going back to you know, this is our actual example that we have just cut and pasted hundreds of times. We don't include any tax advantages in our calculators. We make all of our investing decisions completely agnostic of whatever the IRS thinks. So, you know, for full disclosure, we do claim real estate professional status. We have for a number of years, but we don't factor that into our investments really in any way until we get to the end of the tax year and say, okay, no tax again. That's going to be very different for someone who has a high income, who's in a high tax bracket. You probably would want to consider tax advantages. That can be another monthly topic that we talk about at some point. But I think one thing that we've always tried to be very cautious of is not allowing the tax tail to wag the dog.
That's right.
So buy investments that are good, high quality investments, that are good properties in good neighborhoods, that there's a good story behind them. People want to live in them. People want to rent them. Or if you're in commercial, a tenant wants to be in that space, that have good, solid financials. And then any tax advantages are extra. I see a lot of people buying like negative cash flow assets just to get the tax advantages. And I think we might be there in, you know, the next 5 years as the market just gets tighter and tighter and tighter. But to the extent possible, I would encourage you to try to buy good assets with good fundamentals and then think about the tax advantages from them.
Yep. All right.
Any questions? Anybody want to chime in? We'll go a couple more minutes here to make sure we get to that Q&A portion.
I guess I'm grateful for the material we actually did successfully cover.
Yeah.
Oh, thank you. We appreciate everyone coming here.
Yeah. We're doing another presentation tomorrow. Rare for us to do
Doubleheader.
2 in a row like that, just kind of the way the schedule worked out. So tomorrow we are partnering up with our mindset coach, Jason Dries. He's going to do about a half an hour, basically doing a little mini mindset lesson. So that's what we do with him once a week. We each coach individually, and then we'll have about 30 minutes where we talk about how we've managed our mindset and stayed very mindset healthy in an ever shifting market. Single family homes are very expensive. Interest rates have been changing, all sorts of things, multifamily, COVID, how we keep our relationship healthy through all of that, and how we've been doing that for the past 10 years. So there's more attention on it recently as you know, the changes in the housing market are on the front page of the paper in the way they weren't maybe 5 years ago, but the market has been shifting the entire time we've been investing, and we've just kept our mindset very healthy and kept looking for opportunity and shifted. And so that's what we'll be talking about tomorrow. The sign up link is in the Facebook group. It's same time, 7 p.m. Central tomorrow. So if you want more of us this week, we'd love to see you there too.
All right. Thanks, everyone.
Bye, everyone. Thank you. Thanks so much for your attendance. We really appreciate it a great deal. It was so nice to see so many familiar faces and some new faces too.
See you soon.
Good night.